More Canadians than ever before are working past the age of 65. Some because they want to, some because they need to, and a growing number because they discovered that a part-time job, a consulting contract, or a small business they started after retirement gives them a sense of purpose that a full retirement did not. Whatever the reason, working in retirement in Canada is becoming the norm rather than the exception. And yet, almost nobody gives these Canadians a clear answer to the most important question they have. What does working actually do to my CPP, my OAS, my GIS, and my taxes? Because it is not simple. Working after 65 while collecting government benefits creates interactions that can help you significantly or cost you significantly, depending on how you handle it. And most people navigating this do not realize the rules have changed in recent years in ways that actually favor them. In this video, I am going to give you a complete, clear picture of every significant way that working in retirement affects your government benefits and your tax situation. And I'm going to tell you about a program that almost no working senior knows about that is putting real extra money in the pockets of people who do exactly what you are doing. My name is Grace Donovan. Let us get into it. Let us start with CPP, because this is where the rules changed most significantly and most favorably. Before 2012, if you were collecting CPP and still working, you had to stop contributing to CPP. You were done. The account was closed. That changed. Today, if you are between the ages of 60 and 70, still working and already receiving your CPP retirement pension, you can continue making CPP contributions, and so does your employer if you have one. These contributions go into what is called the post-retirement benefit, or PRB. Each year you contribute after starting CPP, you earn an additional small monthly benefit that gets added to your CPP permanently starting the following January. It is not large in any single year, but it compounds, and it is indexed to inflation. For someone who continues working and contributing for 5 or 10 years after starting CPP, the accumulated PRB can add a meaningful amount to their monthly income for the rest of their life. If you are self-employed and working after 65 while collecting CPP, you contribute both the employee and employer portions, which is more to pay, but also more benefit you accumulate. Here is the key decision point. Between ages 65 and 70, you can actually choose to opt out of making CPP contributions if you are already receiving your CPP pension. You file a form called the CPT 30 with your employer, and they stop deducting CPP from your pay. You stop accumulating PRB, but you keep more of each paycheck. Whether to opt out or continue contributing depends on your age, your health, how much you earn, and how long you expect to continue working. In general, if you are in good health and plan to work for several more years, continuing to contribute and accumulating PRB tends to produce a positive return. If you plan to stop within a year or two, the math becomes less favorable. Ask your HR department or payroll provider about the CPT 30 and think about this decision consciously rather than just letting it happen by default. Now let us talk about OAS and working income. Good news here. Working does not reduce your OAS. Period. You can earn any amount from employment or self-employment, and your OAS payment stays the same. The issue with OAS and working income comes through the back door, through total income. If your combined income, including employment income, CPP, OAS, investment income, RRIF withdrawals, and everything else, exceeds approximately $90,000, you will start to see the OAS clawback we discussed in video 3. For most part-time working seniors, this threshold is not a concern. But for seniors doing significant consulting work, earning a high hourly rate, or running a profitable small business, it is worth monitoring your total income as the year progresses to avoid a surprise clawback at tax time. Now let us talk about GIS and working income, and this is where things get most complicated. If you are receiving the Guaranteed Income Supplement, employment income affects your GIS, but in a more nuanced way than most people know. As of 2021, the first $5,000 of employment or self-employment income you earn does not affect your GIS at all. It is excluded from the calculation. The government made this change specifically to encourage lower-income seniors to continue working without penalty. Above $5,000, GIS is reduced by 50 cents for every dollar of additional employment income. So, if you earn $10,000 working, the first $5,000 is exempt, and the next $5,000 reduces your GIS by $2,500 for the year. This is a significant reduction, but there is a nuance that is worth understanding. The calculation uses 50% of earnings above $5,000, not 100%. So you are not simply losing all the money you earn. You are losing half of it above the $5,000 threshold, while keeping the other half plus the full exempt $5,000. For many GIS recipients, working part-time up to a certain point produces a net positive income even after the GIS reduction. The key is to know your numbers before you take a job, not after. Here is the calculation to do. Figure out how much you would earn from the job in the year. Subtract $5,000. Divide the result by 2. That is approximately how much your annual GIS would decrease. Now compare your net employment income, after tax and after that GIS reduction, to what you would have received without working. If it is positive, working makes financial sense. If it is negative or neutral, you are working for very little net gain. And keep in mind, GIS is recalculated annually in July based on the previous year's tax return. So if you work for 1 year and then stop, your GIS reduction lasts for the following year only and then goes back up. Now let us talk about a program that almost nobody in the working senior population knows about. The Working Income Tax Benefit for Seniors, and more broadly, the Canada Workers Benefit, or CWB. The Canada Workers Benefit is a refundable tax credit available to lower and moderate income working Canadians. As of recent changes, seniors who work and have modest incomes can qualify for this credit, which provides a meaningful financial boost at tax time that effectively supplements their income for working. For a single person, the maximum basic Canada Workers Benefit as of 2025 is approximately $1,428 per year. It begins to phase out as income rises, but for a working senior earning modest employment income, particularly someone who uses the GIS employment exemption wisely, this credit is money back in their pocket that they very likely do not know they are entitled to. The credit is claimed on your annual tax return. If you file your own return, look for Schedule 6. If someone prepares your return, make sure they are claiming it. It is a refundable credit, which means it comes back to you even if your tax owing is 0. Let me also address taxes more broadly for working seniors. When you work in retirement, your employment income is taxable. It is added to your other income, CPP, OAS, RRIF withdrawals, and you pay tax at your marginal rate on the total. The important thing to manage is source deductions. If you are working as an employee, your employer will deduct income tax from each paycheck based on that paycheck alone, without knowing about your other retirement income. This can result in significant underpayment of taxes across the year, which creates a large tax bill in April. To avoid this, you can file a TD1 form with your employer to request additional tax be withheld each paycheck. This spreads the tax burden across the year and eliminates the April surprise. If you are self-employed or working contract, you are responsible for making quarterly tax installments to the CRA yourself. Missing these can result in interest charges. The CRA will notify you if installments are required based on your previous year's tax balance, but do not wait for the letter. If you know you will owe more than $3,000 in tax, set aside and pay installments proactively. Let me summarize the key points clearly. Working after 65 while collecting CPP can increase your future CPP through the post-retirement benefit, unless you actively opt out with a CPT 30 form. Working does not directly reduce your OAS, but high total income can trigger the clawback. Working as a GIS recipient reduces GIS above $5,000 of annual employment income at a rate of 50 cents per dollar. Plan your working hours accordingly. The Canada Workers Benefit may provide an additional refundable tax credit worth up to $1,400 for lower-income working seniors, and manage your tax withholding proactively to avoid a large April tax bill. Working in retirement can be financially rewarding, socially fulfilling, and entirely compatible with collecting your government benefits if you understand the rules and plan accordingly. Drop your questions in the comments. Are you working in retirement or thinking about it? What income are you earning and how is it affecting your benefits? Your specific situation might be more common than you think, and your question might help someone else in the same position. And please share this video with anyone you know who is working past 65 and collecting government benefits. The chances are high they have never had these rules explained to them clearly. I am Grace Donovan. I will see you in the next video.